What's up, everybody? Today we are going to be looking at a few payment processing companies. We're going to be taking a look at Shift4. We're going to be taking a look at PayPal, which I know is always a favorite among retail investors. We're going to be taking a look at XYZ, also known as Square or Block. We're also going to be taking a look at Fiserv, ticker symbol FI, which several people have asked me about recently. And finally, we have one more bonus stock that we're going to look at. It may not fit as neatly into a category as these other four stocks here, but I think it's looking interesting. I think it might be presenting an opportunity. So I hope you stick around for that. As always, if you get value out of the video, subscribe to the channel. If you want, consider following me on Patreon. Now let's get into these companies. On a broad level, all of these businesses are facilitating the movement of money. Whether you're paying your buddy with Cash App, that's owned by Block, XYZ here, or you're going to a restaurant and you have to pay the bill and maybe they have a Shift4 system. You have money in one place, maybe in your account, your wallet, and you're trying to move that to someone else's wallet. All of these companies are competing for different little sub-segments of that market. And apparently I just lost internet connection here. I am traveling, so I hope the sound quality is okay. That is why I haven't uploaded a video in a few days, but I wanted to get this one out for you today. Now there's a couple things I think we should be aware of if we're looking to invest in this space. First, just a tailwind, a positive. This is a sector that is usually naturally hedged against inflation. Most of these companies are taking a take rate, meaning say you're paying $100 for something online and you are checking out using PayPal, or maybe you're paying $100 for a restaurant at a bill with a Shift4 little point of sale terminal. The company that's processing that payment is taking a little bit of that total transaction volume. Maybe let's say 2%. So as the price of, restaurants goes up, or as the price of whatever it is you're buying online goes up over time, the revenue that these companies are making is also going up. Now, another tailwind is more and more transactions are becoming digital. Cash is still used, especially depending on what part of the world you're in. But as more and more payments become digital, that's going to be another tailwind for most of these companies. Now, the flip side of that coin is these businesses are very linked to the broader economy. If people start consuming less, if they start going out to fewer restaurants, staying in fewer hotels, buying fewer things online, then that is going to be a negative for most of these companies here. Also, and this is a big thing to note before we dive into specifics on individual companies, it is very difficult to have a moat in this space. There are competitive advantages that certain of these businesses have, but in general, these companies don't own the customer. Usually a merchant has someone's business and they're interacting with the customer and they have a choice about, how to process those payments. One of the main ways that companies compete here is on take rate. Someone else wants to process that payment for, 2.5% of transaction volume. Well, guess what? I'll do it for 2%. I'll do it for, 1.8%. There's a risk that there's going to be a little bit of a race to the bottom as far as take rates are concerned. And in general, take rates have been trending down over time for many of these companies. That's something we should think about as we forecast the future. You're not going to see 30-40% operating margins for many of these businesses here. Now, let's dive into it and let's start with Shift4. There's some other companies we could have looked at today. We could have looked at Global Payments or dLocal or maybe StoneCo. StoneCo is a company that I own and I've done videos about in the past. So if there's anything you want to see, leave that down in the comments below. We're not going to do a deep dive on any one of these companies just so that we can talk about a bunch in this video. But let's get into Shift4. Shift4 has focused on hospitality, hotels, restaurants, also maybe casinos. You might have used them in the past when you've gone out and not even realized it. They have these point of sale terminals, and Shift4 has really grown in the past several years by solving a fairly specific problem that a lot of these hospitality players have. Unlike something like PayPal, where you're buying online, you don't need a credit card physically present to make the transaction. At a restaurant or hotel, a card needs to be physically present. So there needs to be some actual piece of hardware, a point of sale terminal like what you see here. They then need someone to process the payment. Maybe they also want an easy way to add, a tip or split the bill or something like that. The software and hardware side need to talk to each other. Previously, hotels, restaurants, a lot of them did not have an all-in-one solution to this. Well, this is the problem that Shift4 was solving. They were the all-in-one solution. They have had just massive growth, and because they're also integrated with hardware, there is a switching cost here. It would be annoying for clients to switch out Shift4 for another processor. We see here they become the market leader in hotels, the market leader in sports and entertainment. you want to buy your popcorn or hot dog, a lot of times you're going to be paying with Shift4. I think of all the companies we're going to look at today, the growth path is most clear with Shift4. I think the 30% growth rate we're looking at now is likely to slow down over time. But not only do I think top line growth is going to be strong, look at their margins. Their margins flipped into profitability just a few years ago in 2022. And as the company scales out, margins are expanding, and I expect this to continue. Margins will continue going up. It's a little bit of a question mark to me where this will get to. Because they have this hardware side to their company, I think margins will be lower than maybe a more software play like PayPal. But I think margins in the low to mid-teens is very reasonable. Putting in some numbers for my base case, I'm assuming 15% growth every year for the next 5 years. This is definitely a slowdown from where they've been, but as the company scales up, they are going to slow down. For what it's worth, analysts are estimating the company grows 22%, I believe, for the next 3 years. Take that for what you will. Operating margin, I have them getting to a 12% operating margin. I don't consider this very optimistic. It's certainly not high relative to their peers. I'm giving them no credit for free cash flow. They're going to need to use their money to expand to fuel the growth that we have seen. And I'm just giving them a 16 times multiple. I really don't think I've made any crazy assumptions here, and in this scenario, you're looking at a 14% annualized return on this stock, or almost a double over 5 years. I think this company looks interesting. It's definitely one I'm going to keep my eye on. If they maintain their strong growth, 20% on the top line, I give them 15% operating margins, which is reasonable if you look at comparable companies, and I give them a 20 times multiple. This is the upside here. You're looking at a 31% annualized return, close to a quadruple on this stock over 5 years. And as far as what the risk is, growth slows down, operating margins fall pretty short where people are hoping for, and I'm only giving them a 12 times multiple. And yeah, if this scenario plays out, you're down on your money over 5 years. Overall, I think the risk reward is decent. If this stock falls lower, maybe, to around the $60 level, I think I'm going to be very interested, and we'll do another deep dive if it gets down there. Right now, I don't own the stock. In fact, the only one I own is the next company we're going to talk about, and it's PayPal. I do have a small position here, not a large part of my portfolio. This is a popular stock to talk about, it seems. I've seen 4 or 5 videos pop up on my feed about PayPal just in the past week. This is a much larger company than Shift4. Growth has slowed down a bit. In fact, recently, PayPal has focused more on profitable growth, not necessarily growth at any cost. They have seen their operating margins improve over the past few years. They are using the money that they are making to aggressively buy back shares. The share count has dropped a ton in the past few years. And this brings me to maybe 2 things I've heard people say about PayPal in videos, which I think they're getting wrong. The first is just inaccurate information about the realistic scale of PayPal's buyback program. Some people say that PayPal is going to buy back, $20 billion of shares because, they have some buyback authorization program that they announced. And while having a large authorization for buybacks can be very headline grabbing, it's not really something I recommend you focus on. This is not going to be all spent on buybacks this year. It might not all be spent on buybacks over the next several years. Frankly, they don't have this money to spend on buybacks today, right now. Buybacks are funded by the actual money that a company makes, the profitability of the underlying business. We look at what is a reasonable free cash flow that the underlying business will create, and what do they plan to do with that money. In this case, management is clear that they plan to spend a lot of that on buybacks. Now, if you say, okay, fine, so it's not going to be like $20 billion of buybacks, but free cash flow, they're estimating $6 to $7 billion of free cash flow. This company has a market cap of 66-ish billion dollars. So that's like a 10% buyback yield, roughly. They're going to be buying back 10% of their shares every single year. Well, this brings me to the second mistake that I see some people make, or maybe they're just ignoring this. PayPal also has a ton of share-based compensation. So not only are they buying back stock, they're also issuing stock to employees. That's part of their compensation. This is a real operating expense. If we're interested in the share reduction from buybacks, what we really should be looking at is, the net share reduction. So you have some shares that are being retired from buybacks, but also you're issuing some shares as part of compensation. What is the net reduction? What I look at here is adjusted free cash flow, meaning free cash flow, but then I adjust that for the share-based compensation. I subtract out this share-based compensation. And when you do that, you're looking at, maybe closer to a 7% free cash flow yield. And that I think is a more reasonable number to expect for the net reduction in shares if prices remain, roughly where they are. For what it's worth, that's still an extremely high number, just, not the 10% or so that you see some other people talking about. Because I've talked about about PayPal a couple times in the past. We're not going to, look in depth at the operations of this business. I think that this is a decent quality company trading for a decent valuation. I think my base case is reasonable. I'm just assuming 6% growth on the top line. I'm assuming operating margins stabilize around 17%. They have been going up recently. Some of this depends on the segment mix. Braintree is a lower margin segment of the company. As that expands, as that grows, then, you might see revenue growth accelerate, but margins might pull back. Also, as they begin to monetize Venmo, that could accelerate margins a little bit. Right now, Venmo, very low margin. Overall, I think 17% is reasonable. Free cash flow margin, essentially, these are the numbers here that I'm assuming are coming back to shareholders in the form of buybacks. And at the end of the day, I'm giving them a 14 times multiple. I think that's fair for a solid company like this. And I'm looking at a 15% annualized return on the stock, or, a little more than a double over 5 years. Obviously, they could outperform this. Of course, I think the numbers I put in here are conservative, as I said, but, here's why I like the stock. Look at my bear case. I'm assuming just 2% growth on the top line. Basically, revenue barely keeps up with inflation, operating margins compress, and I'm only giving them a 10 times multiple. And even in this scenario, you're not down on your money over 5 years. That is why I do have a position in PayPal. I just think the risk reward is good here. Just my thoughts. All right, now let's move on. We're going to talk about Square, or Block XYZ as it is now known. The price history of this stock, I have to say, it looks a lot like PayPal. It was up close to $300 a share and now down to under $80 a share. Look at PayPal here. PayPal also over $300 a share in 2021, now down to $70. You could basically put these two charts right on top of each other and, they would look pretty similar. And product-wise as well, there are a lot of similarities. Block owns Cash App, which is comparable to Venmo. You can send money one individual to another without fees. If you want to do other stuff in the app, often there are fees. Something that they have rolled out recently is you can buy and sell Bitcoin on Cash App. When someone does this, Cash App is recognizing the full amount of that Bitcoin sale as revenue. So it distorts their revenue numbers a bit. We can see that their gross profit that they're taking from these transactions is, only about 2% of that transaction volume. Cash App, I would say right now, is monetizing better than Venmo. They are focusing on higher margin segments, buy now, pay later, cards. Venmo, it seems like the strategy PayPal has gone for is scale first and figure out how to profitably convert users later. Venmo is not a big contributor to PayPal's bottom line right now in the way that Cash App is for Block. However, user growth is slowing for Cash App. You see here, this is just Cash App card monthly active users, but definitely slowing down. By the way, I have a slight bias against any company where when you go to their website, you go to their investor relation page, the featured presentation here is from 5 years ago. This is from the end of 2020. Other than Cash App, the legacy side of this business, Square, those little point of sale terminals that you might have seen small merchants use, that's still growing, but companies like Shift4 and also Toast is the leader in restaurants. I could have thrown them into this mix of companies we're looking at here as well, but those companies are growing faster than Square. It feels like they are eating Square's lunch here, so to speak. Another thing to note about Square, this is another company that is just flipping into profitability now, really operating profitability. They've had a couple years where they've posted positive numbers in the past, but just kind of flipping into solid profitability here over the past year or two. And they do have a ton of share-based compensation as well. I mean, over $1 billion in share-based compensation. This is a massive amount, and the profitability that they have is nowhere close to what a company like PayPal is currently doing. So, they can't be buying back shares in the way that PayPal is. Forecasting some numbers for what we might expect going forward. I mean, I put in 10% growth every year for the next 5 years on the top line. I don't think I can realistically expect more than that in my base case. Operating margins are a bit of a question mark because, again, just flipped into profitability. I think 12% is reasonable, similar to what we put in for Square, a bit lower than PayPal. I think getting there in 5 years might be a bit of a stretch, and I don't think I can really give them any credit for free cash flow. And if I give this company a 15 times multiple, just a little bit higher than PayPal, you are looking at an 8% annualized return over 5 years. That's not too bad, but for me, it's really nothing to get too excited about. Between Shift4, PayPal, and Square, this probably would be my last pick. Again, just my opinion. And also, let me know, if you use both Venmo and Cash App, which one do you prefer? Where do you see that battle shaping up over the next 5 years? Now, let's get on to the next stock. And I know I said I was going to talk about Fiserv, ticker symbol FI, but Getting a little bit pushed for time here, and I think this company requires a bit more of a deep dive. I do think it's interesting. I am going to do a video just on Fiserv, but we are going to skip it for now. I want to talk about our final company for this video, which is going to be Euronet Worldwide. And this is a company I was asked about recently on my Discord for Patreon members. The ticker symbol is EEFT. I was not familiar with this company before. I did do a look into it over the past couple days. It's not a perfect analog to, Shift4, PayPal, Block, the companies we've looked at so far, but they are a financial service company involved in payments, money transfer, and I think there's a potential deep value opportunity here, and I wanted to present it in this video. We see revenue growth has just been beautiful here up and to the right, with the exception of 2020 for COVID. COVID hit them pretty hard. You'll understand why when we look at the segments of their business, but as they have been increasing revenue, also margins have been going up. Operating margins now in the low teens. Again, they took a significant hit in COVID, but they are bouncing back strongly. Now, as far as what this company does, they operate in roughly 3 segments. They break them down as electronic funds transfer. This is what I would describe as their legacy business. They have a bunch of ATMs that are around Europe and Asia also. If you've ever been a tourist in Europe, you've probably seen them. They literally have thousands of ATMs there. And if you take out money, you're going to pay a fee. Also, if you have to convert currency, if you're traveling and your home account is in dollars, but you're trying to withdraw euros, you're going to pay a significant fee. The margins here are very strong. This segment makes up only about a quarter of revenue, but closer to 45% of earnings. The next segment is ePay. They partner with brands and they sell prepaid cards, gift cards for these brands. We see they recently signed a deal with Riot Games. They have deals with Amazon Prime, whole bunch of other companies. This segment is a bit more about scale. Margins are lower. And finally, the third segment is money transfer. They own Ria, which if you live in Europe, you probably are familiar with this brand. I know when I was traveling in Europe, I saw Rias all over the place. They're maybe similar to like a Western Union in the United States. If you want to send money across border, if you want to do any cross-border payments, they handle those payments, they handle those transactions, and they take a spread on the FX conversion and also a bit of a fee. Now, even though they are only reporting in 3 segments here, I really should mention a fourth because Euronet is closing on an acquisition of CoreCard. CoreCard is a car issuing and processing platform. Their biggest client is Apple Card and Goldman Sachs. So Euronet is really trying to diversify away from some of the other parts of their business that are a bit more dependent on a cash economy. They're trying to become more of a full service payments processor here. I think this is a good move. They say this is going to be accretive to adjusted EPS in the first 12 months alone, which is nice when you are doing an all stock deal that can be very dilutive to earnings per share. They say, no, it's going to help out earnings per share, even though, yes, we are doing this purchase with stock, with equity. Overall, this looks like a very well-run business. I think management is making a lot of good moves, but the market is not giving them credit. The stock is lower today than it was 7 years ago, in spite of the fact that during that time, revenues, earnings, everything is up significantly. This company is now trading for a single-digit multiple of operating income. And yes, there are risks. The risk here is that, hey, a lot of their business is still dependent on cash. You have a quarter of their revenue and more than 40% of their earnings coming from ATMs. Understandably, the market views that as a risk, but they still have been growing very strongly. And I think the company is making good moves. And with the money that they're making, with the cash that this business generates, they are buying back a ton of stock quite aggressively right now, down to 40 million shares from 50 million shares just a couple of years ago. So we're getting paid while we wait here. As far as what we can expect for the future in this company, I put in 6% revenue growth. That's a bit slower than what they've been doing, but I expect a bit of a slowdown here. And operating margins have been fairly consistent. And in fact, they've been improving recently, but I pulled them back to 12% from where they have been, 13% right now. They are rewarding shareholders with buybacks. So that's what these numbers are representing here. This free cash flow, this is what I think can be coming back to us in the form of buybacks. And I'm only giving them a 10 times multiple. I think this is completely fair for a business like this. And in this scenario, you're looking at a 17% annualized return on this stock. This is more than a double in 5 years. As far as what the downside is, what's the bear case? I want to do more of a deep dive here, but just to put in some rough numbers, let's assume revenue is completely stagnant. No growth on the top line. Operating margins compress even more. We bring their free cash flow margin back as well. They're returning less money to us shareholders, and I'm only going to give them an 8 times multiple. And even in this scenario, you are flat on your money after 5 years. You aren't down, even with these pessimistic numbers that we put in. I think Euronet is looking very interesting. If any of you own this company or you've looked at it, let me know what you think down in the comments below. When they release their next quarter's earnings, I think we're going to do a deep dive on this company, dive into the earnings call and see, is there a deep value opportunity here? Because just looking at the numbers, yeah, I think there's potential for deep value here with Euronet. So I think we're going to end the video here. If you got value out of the video, subscribe to the channel. Nothing here is advice to buy or sell any of these stocks. I'm just giving you my opinion. If you want to make Google Sheets like this, or if you just want to grab my template, consider supporting me on Patreon. And as always, if you agree or disagree with anything I said, let me know why down in the comments. And I hope to see you all in another video.